All right, all right, all right. Yes, we are here, right? We are here at my favorite part of the presentation of the whole course of life, right? Because just the concept of investing, right? That you get in or you get out what you put in, right? And you can't get anything out unless you put things in, right? Unless you invest in yourself, you can't get the best out of yourself. Unless you invest in your children, you can't get the proper results from your children, right? Like it's pretty straightforward, right? And so with investing is just a key component to this entire course. And like I said, just a key component to my life and the life of millions of others. So um, let's get into it for real. Let's get into it. So look, first and foremost, most people don't invest because they believe that they don't have enough to start. A lot of people has been given a false concept of investing, right? And given a big concept that they can't really see for themselves, right? Even though they don't understand that they're already investing. You're already investing. When you buy products from stores, you're investing in that company. You're just not investing to get a return for it. The return you get is the product. But outside of the actual product, there's no other financial gains that you receive from giving your money to certain companies, right? So, so this section is to prove that belief wrong, right? Absolutely wrong, and show exactly how to put your money to work, right? Because your money is supposed to be your employee, whether you have a business or not. The money that you have is supposed to work for you, right? It's supposed to move while you sleep. It's supposed to move in ways in areas that you are not in and that you're not capable of being in. And so we really want to jump into this entire concept, right? So first and foremost, um, some major investment um, vehicles, right, that are utilized today. Um, that those would be 401ks and IRAs, right? So if you got a job, if you have the blessing and the opportunity to enroll in their 401k program, like we said at the beginning, 401ks have taken the place of pensions, right? Have taken the liability off of companies that we work for to actually produce wealth for us after we stop working, right? And so 401ks really is nothing but a fund, a fund that a company allows you to invest in. And this fund is just a collection of other stocks, right? So it's really not too much. It's really not out of the ordinary, and really not too far fetched. Even though through like the documentation, it can be pretty confusing. But at its most basic and fundamentals, it is just a collection of stocks that are grouped into a fund that you get a chance to invest in. And as that fund rises or falls, your money goes with it. After 401ks, we got IRAs, right? Um, Individual retirement accounts, right? And this is just another vehicle or vessel of investing, particularly for people who are not interested in actually watching and managing the funds or the stocks that they're invested in. They just want to put some money down and just watch it grow. And that's cool. It's absolutely good. So when we deal with 401ks and IRAs, right? The majority of them, they deal with four different sectors, right? So you have conservative funds. So these conservative funds, they are high quality bonds and safe assets, right? Really, and they really lose value, but they grow very, very slowly. And these typically see returns under 3%, right? Um, and also with the value fund, right? The stable, undervalued companies that pay dividends, right? Dividends are very important. Um, Moderate risk, but they have steady growth, right? And they also have a 3% return, right? And so, like we've been preaching from the beginning, a 3% return is amazing. It's not so amazing when inflation is over 6%, because that really means that the value of your money is decreasing in value on a daily basis. So if you have a 401k plan and you save up $500,000, right? $500,000 is going to be worth maybe $100,000 in another 10 years, right? But you're still going to have the $500,000. And so it's really not about the amount of money, it's about the amount of products, the cost of products moving into the future, right? And how much that money will be able to buy, right? The perfect example is the supermarket, right? You used to be able to go into the supermarket with $20 and get maybe 2 bags of groceries. Now you can get maybe 3 items for $20, right? So the products haven't gone anywhere, but the value of your money has. And so after the value fund, we have the balance fund, right? So this balance fund, um, it's a mix of value stocks, right? Value stocks and uh, value stocks and safe bonds for moderate risk, right? And usually you get returns between 6 to 8%, and that's great. That's great. 6 to 8% is very, very, very um, favorable and sought out in the investment world, and it's good, right? And so it's like I said, it's a mix of value stocks and safe bonds, and these items produce the return on investment that we look for of between 6 to 8%, right? And then we have aggressive growth, right? And these are more high risk, high reward equities, really hunting for the next big winner, right? So, like aggressive stocks right now with things like Tesla and I wouldn't say Microsoft is such an aggressive stock, but typically aggressive stocks are fairly new and have generated a lot of attention and a lot of buzz behind them. Um, but they can be volatile because people don't know or are not certain of their lasting potential and how they will fare throughout the years of the market and all the investors that are within it. And so with these growth rates, these aggressive growth funds, the returns on these are usually range between 8 to 17%, right? These are amazing returns. These are amazing returns that people really, really sought after. And so, but in investing in 401ks, investing in IRAs, just investing in money management firms, like you always have the option of what kind of fund you want to participate in. And normally, for older people, for people up in age, they usually tend to direct you towards the more conservative funds because at that point of life, they really don't want you to lose money. They just want you to gain money. But like I said, if inflation is so high, you're already losing money by investing in things that are not bringing you returns higher than the rate of inflation. So it's very important. It's always your choice, but it's very important to have that understanding and that concept always in the back of your mind. All right. So, um, and with those funds, right? Those are collective funds, right? They put together um, various different stocks. But if you just want to invest particularly in stocks or in bonds, right, you can do that, right? And a stock represents a fractional ownership in a corporation. As the company grows and profits, so does your share value because you can buy shares of that company. The return potential is theoretically unlimited because as a business, there's no cap to how much money can be made as a business. Different things can be forecasted, but if you have a perfect set of circumstances, your business can make $100,000, $1 million. It can make $1 trillion if possible, right? If the work is there to produce that, right? And so because of that, uh, the share values is unlimited potentially. Um, and so it's tied directly to the performance and trajectory of the business you invest in. So stocks are the primary engine of long-term wealth building for individual investors, right? And then we have bonds. A bond is essentially a loan that you make to a government or to a company, right? And so, they have bonds for toll booths, right? For you to be able to fund the creation and the maintenance of toll booths, and for you doing that, they will give you percentages back for it, and which is a smart idea because, like I said before, just to be able to utilize the things that you already utilize every day within the stock market. So typically, bonds produce 2% or less, right? And really against inflation, that's not really working. But as a long-term vehicle, a long-term wealth producing vehicle, that's always a possibility. And so we have next up, we have cryptocurrency. Cryptocurrency.